Welcome back. You're watching The Money Show on ET Now. We just had an in-depth discussion on the trend, and that is the MCLR rate cuts. That's something that a lot of banks have indulged in, especially after the RBI has told banks that, you know what, you need to pass on that lower interest rate to customers like you and me. Now let's talk about a trend seen in 2019, and that was NCDs or non-convertible debentures. Now we do know that the debt market had a lot of fear, especially since IL&FS defaulted significantly and DHFL as well, in fact, went into IBC. But despite this environment of fear in the debt markets, it was interesting to note that not a single NCD issue failed in 2019, and all the companies that did offer these instruments managed to raise at least the base amount, which means that retail investors and investors in general were really subscribing to these NCDs, which is pretty impressive. So they had an appetite for top-notch names like, your L&T Finance, Tata Capital Financial Services, M&M Finance. Though, mind you, if you look at the trend, the amount raised is definitely low. It's only 17,000 crore rupees as per Prime database. But nevertheless, despite the weak debt market, investors still gobbled up these NCDs, which then, begets the question, are these NCDs worth holding in your portfolio? Because I suppose one key reason why investors would be opting for NCDs is the fact that the interest rates are extremely attractive. To give you an example, we do have the Shriram Transport NCD that's currently open for subscription. Let me run you through what exactly are the interest rates that are being offered. If they want to raise 1,000 crore rupees through these public deposits, and while of course they defer tenure to tenure, etc., these bonds will be offering a coupon in the range of 8.52 to 9.1%. It's going to open on the 6th of January. But again, like you can see, right, 8.52 to 9.1% is certainly quite an attractive interest rate, that a particular bond is giving. Similarly, you have a Tata Capital as well, which is offering its NCD at this point of time. So, like you can see, firstly, they are going in for such NCDs, and secondly, the interest rates are pretty attractive. So, it does tend to lure a lot of investors that instead of going for a PPF or instead of going for, an equity mutual fund that had a bad time in 2019, why not these NCDs that are assuring these returns? Well, we'll tell you the advantages and the disadvantages of whether you should including an NCD in your kitty. And for that, we have brought on board Feroz Aziz of Anand Rathi Financial Services. Feroz, thank you so much for joining us on The Money Show. And Feroz is at this point of time in the chills of the United States. I hope, you're enjoying your new year over there. So Feroz, we were talking about how investors gobbled up NCDs in 2019 despite the weak debt market, despite all the fears that plagued the debt market, in the year gone by. Why do you think this happened? What exactly lured investors towards this NCD market?
The NCDs are issued with a clear understanding of what's the appetite. So when you look at the entire subscription happening, because these are not very large contents, the size of the debt market is very large. If you look at the mutual fund industry, it is 15-16 lakh crore industry through the mutual fund route. Since NCDs are very well planned, marketed, and has an appetite measure, and then comes the launch of these NCDs. That's why optically it looks like all of them have been subscribed, but they've been designed in such a fashion that the supply is limited to the anticipated demand. So that's one reason. Point one. Point two, if you want to understand the right demand of the NCD market, the secondary market also gives you a very good indication of what the kind of demand which is there actually after all these episodes. So whatever you just said, the speed breakers we have had in the debt market has definitely shown the yield spike in the NCD market. Today, you have a lot of NBFCs, NCDs quoting at 12% yield, which implies that the risk aversion is actually there, and that's one large measure of whether it's being accepted or not in the marketplace.
Okay, fair enough. Feroz, I'd also like to talk to you then about the returns of an NCD. I was just giving our viewers an example of what Shriram Transport offers. Some of them even offer almost 12 to 13%. It certainly is very exciting. So if you could just talk to us on an average, how do the returns of an NCD differ from an FD or a debt mutual fund, not just interest-wise, but on an overall basis, even on a capital appreciation basis?
See, a fixed deposit, if a lot of corporates issue fixed deposits as well. So if you look at fixed deposits of banks like the PSU banks or the private sector banks, of course, NCDs don't score that well in terms of the risk they actually take on your behalf, which is far more than a bank fixed deposit, which is regulated by RBI. But if you compare it with corporate fixed deposits, an NCD is a better instrument because it has a secured debt kind of a labeling. Secured debt is nothing but a debt instrument which has a priority in case the company who's issuing the NCD or the fixed deposit goes bankrupt or they files for bankruptcy or is insolvent. The point one I'm making, NCDs are better off than fixed deposits issued by corporates because fixed deposits issued by corporates are not secured, but NCDs are. But when you compare it with bank fixed deposits, NCDs don't score that well. Be it the credit risk, be it the liquidity which it provides, I think bank fixed deposits win over on the risk side, not on the return side, of course.
All right. What about taxation? Because that, is also something that should be a key consideration when investors make their investment decision, especially if you're in the higher tax bracket, right? Because that in turn could lead to some instruments becoming not so tax efficient. So what about the taxation of an NCD, both during when you're earning the interest, which may be on an annual, quarterly, or a biannual basis, and when you finally sell the bond? There will be, of course, some capital appreciation, some capital gain taxation as well. So if you could explain the taxation bit.
The interest is taxed as per the marginal tax rate of the individual who owns it. So point one, they are at par with the bank fixed deposit interest which accrues to you on a quarterly or a yearly basis. So that's point one. Point two, NCDs are so unitized that you can actually plan your taxes across few family members. So that's one advantage which NCDs have. So from an interest income perspective, both are at par. Then comes very important point, like Mubina, you said, that's the capital gain. The capital gain, if any, and if you're able to sell that NCD in the marketplace, is when you will get a capital gain, which is unlikely because the liquidity is very bleak. But if you so were to accrue some capital gain, that's going to be taxed at the rate of 20% with indexation or 10% without indexation. So let me correct myself. I think indexation as per Section 48 is not available for bonds and debentures. So 10% flat rate if it is a listed NCD, and if it's an unlisted NCD, then it's 20%. And 2 years becomes the criteria for it to become long term in the unlisted category. And if it's a listed debenture, 1 year is what you will have to wait. So 1 year, 10% listed, 2 years, 20% unlisted for the capital gain bracket plus the cess of the relevant bracket that individual falls into.
Okay, fair enough. I also want to talk to you about the risk, right? And I think this is very, very important because, Feroz, 2018, 2019 as well, we've seen AAA rated companies actually default. And that's obviously affected the NCDs, but it's also affected those mutual funds that have exposure. So the NAVs have dropped significantly. And I think these were the reasons why the debt market as well saw, investor confidence diminishing. So, what is the key risk? I mean, the fact that you're just buying one company's NCD, the concentration risk, and again, because that minimum amount that you have to invest in that particular NCD is so high, so diversification as well becomes a bit expensive. So do you think this concentration risk would be the biggest risk when you invest in an NCD?
Yes, concentration is a very, very important risk because most people, when they buy a mutual fund, they don't realize that they've in effect lent to 50, 100 corporates. If I buy five debt funds, you would have at least lent to 150 corporates. And buying 150 NCDs is practically an impossibility for a retail investor. So, Movina, absolutely concentration risk goes up dramatically. Point two, I don't think retail investors understand credit risk and its measurement. Market risk is still a popular risk. Credit risk measurements, the retail investors or any even an HNI. I have met several ultra HNI individuals. Their only measure to credit risk is rating, and that's proved not to be the best measure. So they don't know to measure credit risk. So taking credit risk without knowing to measure it is a recipe for disaster. So I would say that you should not touch an NCD with a barge pole. If you could buy yourself a mutual fund and get the desired diversification, when the age-old saying "not all eggs in one basket" is the most relevant for an asset class which is debt and not as much for equity. So I subscribe to the same opinion, Movina, that you have NCDs which have concentration risk, and that too a risk which most people don't have the capability or the bandwidth to measure.
Okay, yeah, it can get a little complicated, and especially if you have to actually track what rating agencies are sort of, rating, and what sort of rating are they assigning the companies, especially whose NCDs you own. So finally, Feroz, if we just have to summarize our entire conversation, should a retail investor then consider an NCD as a suitable investment option in their portfolio?
No, I don't think so. An NCD which can give you 1.5% more than a debt fund is not worth the extra return for the incremental risk you bring into your portfolio. Because credit risk is the biggest risk known to mankind, because it breaks your back. You get all of it or you mostly get nothing. So it's not like market risk that today the market is down 2%, so you lose 2%, 98 is still safe. But in credit risk, if there's an event which happens, you lose most of your money. And that's why credit risk is also called a binary risk, all or nothing. Yes, to summarize, Mubina, you're right. NCDs you should stay away from unless there is a large differential, which is not there any which way. To summarize, you should stay away.
Okay, Feroz, thanks so much then for joining us on this edition of The Money Show and explaining to us all that you need to know about NCDs. Well, folks, there you have it. According to Feroz, despite however attractive those interest rates on an NCD may seem, it's not exactly advisable to essentially opt for them simply because there's just too much risk. And as retail investors, you may not have the time to really track these.